They call it a public offering. You get 20%. And there's a reason for that number. A specific, legal reason most people have never heard. But we'll get to that in a minute. That word public is doing a lot of work here. SpaceX is reportedly cutting the retail allocation on its eventual IPO down to somewhere in the low 20% range. That means roughly 80% of whatever shares exist at the moment this company goes public will go to institutional investors, funds, and insiders, before regular people even see the opening bell. Stop. Before you get frustrated at SpaceX, most people do, and I get it. You need to hear what's actually driving this. Because the frustration is real, but it's aimed at the wrong thing entirely. Most people hear that and they blame SpaceX, or Wall Street, or the system in general. Here's what's actually true. SpaceX isn't doing anything unusual. They're doing exactly what every major company does. The frustration should be pointed somewhere much earlier in the story, about 90 years earlier to be precise. I'll show you exactly where in a moment. Think about where SpaceX was valued in its early private rounds. Around 2012, the company was worth roughly $2.4 billion. Today it's being valued somewhere north of $350 billion. That's not a typo. That's a 140+ times increase in value. And virtually all of that growth happened while the company was private, completely off limits to you. Let that land. You didn't miss the beginning of this story. You were legally prevented from being in it. So by the time you get your shot at the public offering, most of the money has already been made. People think the IPO is the starting gun. It's actually the finish line for the people who are already running. You're not getting in at the beginning of the story. You're getting in at the epilogue, and you're getting 20% of the epilogue. That's what's actually happening. And if you want to understand why, you need to back up about 90 years. Because what Congress did after the 1929 crash is still shaping your financial options right now, and the mechanism is not what you'd expect. Here's the thing most people never get told. The law decided who was allowed to take the risk of investing in private companies, and it decided that a long time ago. After the 1929 crash, Congress passed securities laws that essentially said private investments are too risky for ordinary people. So they created a category called the accredited investor. To qualify, you need either $1 million in net worth, not counting your home, or income over $200,000 a year. The idea was to protect people who couldn't afford to lose money. Here's where the number gets uncomfortable. According to the SEC, only about 13% of U.S. households qualify as accredited investors. That means 87% of Americans are legally excluded from most private market investments, not because they lack intelligence, not because they lack interest, but because the law drew a line. Now here's the part that almost nobody talks about, and it has to do with when that line was actually drawn and what's happened to it since. We'll get there in a second. So when SpaceX was growing from $24 billion to $350 billion, that growth was available almost exclusively to venture capital firms, sovereign wealth funds, and wealthy individuals. The kind of compounding that early private investors in companies like SpaceX saw, that happened behind a gate that most people couldn't legally open. That's not cynicism. That's not a conspiracy theory. That's the actual, documented structure. And once you see it that way, the 20% retail allocation stops feeling like an insult and starts feeling like a symptom of something much older. But here's the question that actually matters, and it's one almost nobody asks. If the gate was built to protect people, why does it still feel like it's working against them? That answer changes what you do next, and it's coming up right after this. To answer that, you need to look at when that gate was actually built and what the world looked like when someone set the combination. The accredited investor income threshold, $200,000 a year, was written into law in 1982. It has never been meaningfully adjusted for inflation, not once. In 1982, $200,000 had the purchasing power of roughly $600,000 today. People assume the system is predatory, some active conspiracy to keep regular people locked out. Here's what's actually true. It's something almost stranger than that. It's a protection mechanism that calcified in place, designed for one economic era and quietly operating in another, accidentally becoming more exclusionary with every year it goes unadjusted. The gate wasn't moved, the population walked into it. That reframe matters, because if the system is broken by design, you have to fight it. But if the system is broken by neglect, by inertia, Then there are cracks in it, and cracks are something you can work with. Here's what working with those cracks actually looks like, and one of these most people have genuinely never heard of. Since 2020, the SEC has expanded who qualifies as accredited based on professional knowledge, not just net worth. A Series 7 license, a Series 65, or certain other FINRA certifications now count. That's a real pathway that didn't exist 5 years ago, and most people have never heard of it. Beyond credentials, interval funds and certain closed-end structures have started offering limited private market exposure at minimums as low as $10,000. They carry liquidity restrictions and higher fees, and that's worth understanding before you move. But they exist, and they're accessible to non-accredited investors in ways that private equity historically wasn't. And for accredited investors, secondary markets like Forge Global and Hive allow you to buy pre-IPO shares in private companies directly from employees or early investors looking for liquidity. How those secondary markets actually price shares and whether the price is ever fair to the buyer is a separate conversation worth having. But knowing they exist changes what you're building toward. The system isn't fair in its current form, but it isn't a wall. It's a set of rules with specific edges, and specific edges can be found. Now here's the part where I have to say something that might be genuinely unpopular. People treat the IPO moment like it's the opportunity. Get in on opening day, ride the wave. Here's what people think. Early access means early gains. Here's what the data actually shows. A 2023 study from Jay Ritter at the University of Florida. He's tracked IPO performance for decades, found that the average IPO underperforms the broader market over the 3 years after going public. The first day pop, when it happens, usually captures the remaining insider value. Retail investors chasing that pop tend to buy at the top of the excitement. So ask yourself honestly, why do you want to buy SpaceX on IPO day? Because you've been waiting? Because you finally get your shot? That feeling, that exact feeling, is the mechanism that transfers money from excited retail investors to patient institutional ones. It's not a coincidence, it's the design. SpaceX's 20% retail allocation isn't the part that should concern you. The part that should concern you is something about your own behavior on that day, and it's specific. We'll close that loop right now. The IPO isn't the opportunity. It's the off-ramp for the people who are actually in on the opportunity. So what do you actually do with all of this? First, stop measuring your financial life against IPO FOMO. SpaceX going public is a news event. It's not a wealth-building tool for most people. Buying shares on listing day is speculation, not investing. Treat it like one. Second, if you're not yet accredited, look seriously at the knowledge-based pathway the SEC opened in 2020. A Series 65 license is achievable without employer sponsorship, and it now qualifies you as an accredited investor. That's not a hustle. That's a regulatory door that's been left open, and most people don't know it's there. Third, if you want private market exposure without crossing that threshold first, research interval funds with private equity sleeves. Ask your brokerage directly, does anything in my current portfolio touch private markets? Some target date funds and endowment-style structures already do. You may have more exposure than you think, or a clear reason to look for it. And fourth, if building toward that $200,000 income or $1 million net worth threshold feels abstract, make it concrete. Map the distance, know the number. Because what's on the other side of that line, secondary markets, private placements, pre-IPO access, is worth understanding as a destination, not just resenting as a barrier. The system has edges. Now you know where some of them are. They called it a public offering. You get 20%. Now you know the actual answer. It traces back to a law written in 1982 that nobody updated, not to anything SpaceX did deliberately to you. People think the gate was built against them. It wasn't. It was built in a different era and left running on autopilot. Understanding that is the first move. Finding the cracks, the Series 65 pathway, the interval funds, the secondary markets, and working through them deliberately is the second. If this kind of breakdown is useful, the mechanics behind the money news, not just the headline, subscribe so you don't miss when we dig into the next one, and drop a comment, what do you want us to cover? How the Series 65 accredited pathway actually works, how to evaluate an interval fund, how secondary markets like forge price pre-IPO shares, whatever's on your mind. That's what shapes what we make next.